Hello everyone, welcome to the 174th episode of me learning how to trade in Forex. So in the last episode we went through combining trading and investing. When you start combining trading and investing for the first time, best to write down a formal strategy which creates a framework that allows you to monitor your progress as a trader, and you can either use a strategy developed by someone else or come up with your own to test in the market. So the strategy will help you measure the impact of your decisions, keep you from acting impulsively, and help you generate enough data to see whether your plan is working or not. So there's some market participants who trade multiple products using a core satellite strategy. So this is basically at the heart of their portfolio sits a range of long-term financial assets, so mix of shares, bonds, cash and other alternative assets classes such as gold, commodities and property. So they're basically carefully selected and spread out methodically to help reduce your overall portfolio's risk, and this is known as creating your strategic asset allocation. So this core is held for years or even decades, so a really long time. Expectation being that it will provide investors with positive returns over the long term, along with income and dividends that can be reinvested back into the portfolio. So, as we all know, over time, the economic landscape as well as the valuations of each asset class may change. So, therefore, this gives you an opportunity to allocate some asset classes which are growing in value into your portfolio. So, this is known as tactical asset allocation. The satellite part of the strategy will usually involve introducing investments with higher degree of volatility or price fluctuations. You can do this by buying speculative individual shares or funds, or by trading using derivative instruments. And a speculative share stock from a company with a value that's prone to high levels of volatility. As a company is young, its revenue and earnings growth might be unpredictable or as part of a risky industry, but it still has high growth potential. Right? So smart money management is key to succeeding when using this approach. It's important to ensure that you make the distinction between money that's earmarked for building wealth and money that's used for speculative purposes. So money that's used for safe investments versus those who's used for more risky investments. So using a multi-product strategy involves using a combination of investment assets like shares and derivative instruments like spread bets and CFDs to build wealth and manage your risk. A diversified portfolio can be a wonderful wealth creation tool, but it takes a great deal of time and money for it to grow. So because shares prices typically rise over long periods of time, build wealth by holding on to them for years or even decades and possibly reinvesting the dividends. So that's for the long term, and for the short term, using derivative instruments allows you to take advantage of shorter term price movements. And then we've got here about leverage, so owning the fraction of a share's full price to buy it, but with the added risk of losing more to your initial investment. Shorter term speculation on the price movements of financial assets is called trading. So remember, when you trade, you can either take a long position when you think the value of the asset you're trading will rise, or take a short position if you think the value of the asset will fall. So major economic, political, environmental events are known to cause volatility in the financial markets. So keeping on top of current events and news is important for derivative traders, as it could give an indication about the near-term direction of a particular asset. Then we went through the quiz. So a multi-product trading strategy is a good way to add variety to your portfolio because it combines less risking long-term investments with short-term volatility. And then we went through the lesson summary. So now we're on to understanding volatility and risk. So understanding volatility and risk. This G is always out for some reason. So understanding volatility and risk. In the world of finance, one definition of risk is the likelihood that you lose some or all of the money you put into a trade or investment. The risk comes from selling an asset at a lower price than you paid for it. Derivatives trading introduces more risk to your portfolio in a number of ways, one being rapid losses if the market moves in the opposite direction to your trade, e.g. if you take a long position and the stock then decreases in value and vice versa. When you want to take a position on a particular asset, you should first do some research and analyze the asset carefully to get an idea of which direction it may take in the short term. Risk is the likelihood of you losing some or all of the money you put in for a trade or investment. Risk comes from selling an asset at a lower price than you paid for it. Derivatives trading introduces more risk to your portfolio in a number of ways, one being rapid losses if a market moves in the opposite direction of your trade, e.g. if you take a long position and then the stock decreases in value and vice versa. Okay. When you want to take position on a particular asset, you should first do some research and analyze the asset carefully to get an idea of which direction it may take in the short term. So, do some research and analyze the asset carefully to get an idea of which direction it may take in the short term when placing a trade. However, the financial markets can be quite unpredictable. The price of the asset you're trading can move in either direction, regardless of what your research analysis tells you. If this happens, you could potentially lose all your capital depending on the extent to which the market has moved against you. Volatility is closely tied to risk. It relates to the size of price fluctuations for a particular asset over a period of time. So, volatility is closely tied to risk. It relates to the size of price fluctuations. It relates to the size of price fluctuations for a particular asset over a period of time. The higher the levels of volatility, the higher the risk. The higher the levels of volatility, the higher the risk. Volatility is caused by supply and demand in the market. Volatility is caused by supply and demand in the market. Each time a share is bought or sold in the market, its price can change. High demand for a share pushes its price up, and low demand, when many people selling at once, pushes its price down. Each time a share is bought or sold in the market. Each time the share is bought or sold. High demand for share pushes its price up. Low demand or many people selling at once pushes its price down. If many traders buy or sell shares from a single company at the same time, the price fluctuates more as every participant open or close a trade. How you perceive this volatility depends on the specific time frame you're looking at. Simply put, if you watched every single transaction made on a particular share by the second, a chart representing all these small changes would make it appear extremely volatile. But if you track the price of the same share over, say, a 10-year period, it would look like a more stable movement towards today's price. Yep. The risks of trading versus investing. Just as we put money into savings account to benefit from the interest accrued over time, we invest in shares because we hope the value of a company will rise over time. Additionally, some investments pay dividends periodically. You can think of long-term share investments as a large boat that can withstand choppy waters. You still feel the waves, possibly get slightly seasick, and sometimes even get a few splashes of water when the tides are rough, but overall you'll stay relatively dry. However, that doesn't mean that investing in shares comes without risk. For instance, if the price of the share you own goes down and you decide to sell it, you risk losing some or all of the money you paid for it. Example, you believe ABC PLD is a good company to invest in because of its upward trajectory over the last couple of years. One share costs $40, so you buy 50 and pay $2,000. A year passes and you find that the company's value has instead depreciated by $8 per share. So you sell your shares to avoid losing any more of your investment. In the end, you've made a $400 loss on your capital in your efforts to grow your money. Derivative products, on the other hand, allow you to take advantage of price fluctuations. In a liquid market, these changes happen by the seconds, which presents you with the opportunity to make money in a short space of time. But this also means you could lose your capital fast. Remember, you don't have to take ownership of an asset when trading derivatives like you do when you hold shares. Instead, you're buying a contract that allows you to take whatever profit or loss a share makes in the time you're holding that contract. When trading derivatives, you're buying a contract that allows you to take whatever profit or loss a share makes in the time you're holding that contract. Derivative products also allow you to pay a deposit or margin for the contracts you want to add instead of putting up the full share price. You can find out more about margin leverage and derivatives trading in our course, How Spread Betting and CFD Trading Works. Let's use an example to put what we learned above into perspective. Say ABC Ltd is listed at 100 pence per share. The company has had huge success over the years and this has caught your attention. So you decide you want to invest £1,000 of your money in it. If you open a conventional trade with a stockbroker, you'll be able to buy 100 shares with your capital, ignoring commissions and other charges. If the company's share price goes up like 20p, your investment will be worth £1,200. If instead the shares drop by 20 pence each, your shareholding would then be worth £800. On the other hand, if you open a trade using leveraged derivatives, you only need to put up a fraction of the cost of your initial outlay. For instance, if your provider has a 10% margin requirement on the same shares, you only need to pay £100 to open the trade. Question: consider the same scenario as above when the share price rose to 120 pence per share. You still make a £200 profit even though you paid a small amount to enter into trades. If instead the share price dropped to 80 pence per share, you lose 200 still. If you would lose 200, which is double the amount you put into the trade. This is because leverage amplifies both your losses and your gains. As you've seen from the above exercise, derivatives trading may offer great profits in a shorter period, but also introduces more risk than share investing. Not only is it harder to predict short-term changes in a share's price, but you can also lose more money than you initially put in. If a share investment is a large boat, a derivative product is like a jet ski. Goes much faster, but you're more likely to get wet. Affairs? So lesson summary then. Risk in finance refers to the likelihood that you lose some or all of your money by entering into a trade. Volatility relates to the frequency at which the price of a financial asset changes. Long-term investments are generally less risky than trading derivative products. You can lose more money than initially invested when trading leveraged derivatives. Cool. So, using a combined trading and investing approach to your advantage. A strategy that combines shares and derivatives gives you more control over the amount of volatility and risk you're able or willing to take on. For instance, if one of your long-term shareholdings is in a period of heightened growth, you can temporarily increase your exposure by taking a long position on a share to benefit from its price momentum. If one of your long-term shareholdings is in a period of heightened growth, you can temporarily increase your exposure, your risk exposure, right? By taking a long position on a share by taking a long position on that share to benefit from its price momentum. This also holds true for shares you don't already own or even markets you don't typically participate in. That's because you can trade derivative products on several financial asset classes like commodities, stock indices, and currency pairs. So using this strategy to manage your risk, derivative instruments are risky, but they can also be used to reduce risk in your portfolio. They do that in two ways, diversification and hedging. So derivatives can be used to reduce risk in your portfolio. In two ways, diversification and hedging. Diversification. As the old age goes, you shouldn't put all your eggs in one basket. That's where diversification comes in. This is the practice of investing in a range of different asset classes, countries, and sectors in order to reduce risk in a portfolio. So, the practice of investing in a range of different asset classes, countries, and sectors to reduce risk in a portfolio. To successfully diversify a portfolio, you need to think carefully about how different market conditions can impact the investment you hold. Adopting and if this happens, then what will happen mindset is useful here. So to diversify a portfolio, think about how different market conditions can impact the investments you hold. Adapt, and if this happens, then that will happen mindset. So like a cause and an effect mindset then. Trading derivative instruments is one way to diversify your portfolio. These instruments can help balance out overexposure in a share portfolio. This can be done by taking out futures contracts in assets not represented in your portfolio. So did you know a balanced investment portfolio is one that's suited to your risk appetite and investment goals? As the value of investment fluctuates, your portfolio can become unbalanced over time. This could expose you to more risk than you initially intended. When this happens, the portfolio will need to rebalance to ensure that you maintain your preferred risk profile. A balanced investment portfolio is one that's suited to your risk appetite and investment goals. Your investments can become unbalanced over time due to the fluctuations in the value of your investments. So this could expose you to more risks than you intended. Therefore, a rebalance of the portfolio is needed to ensure that you maintain your preferred risk level. You can rebalance your portfolio in a few ways, namely by, so you can rebalance your portfolio by taking profits made from the assets that are overweighted in your portfolio, taking profits made from assets that are overweighted in your portfolio. So if an asset has grown too much in value, is that what they're trying to say? Then just basically take profits from them and sell them? Is that what? But I don't see how that's gonna lower the risk or rebalance your portfolio to your preferred risk profile though. The overweight in your portfolio. Yeah, I don't know. Okay, that overweight in your portfolio. Buying assets that are unrelated to the ones you already own. Unrelated to the ones you already own. Waiting for the market to restore balance with the falling share price. Waiting for the market to restore balance with a falling share price. Once balance is restored, you can close your derivative positions in the market until you need to diversify your holdings again. Oh, so this is like if one thing goes up, if one asset goes up, then the other asset might go down. So, or if one asset goes down, then the other asset might go up. So, to prevent you losing out too much on the asset that's going down, you buy the asset that's going up. So if one does happen, the other one always off balances it, or balances it out, I guess, so that you won't make too much of a loss on it. So this is where the futures contract comes in, not representing your portfolio, because futures contracts are, no, they're mandatory, aren't they? I thought it'd be an options contract, because options gives you the ability, what's that word? You don't have to do it. You don't have to take the trade. Whereas futures is you have to take the trade, even if it goes against you. So once balance is restored, you can close your derivative positions in the market till you need to diversify your holdings again. Hedging. Hedging is a practice of reducing exposure to an existing investment by placing a derivative trade in the opposite direction. Oh, I think what I was talking about is hedging then. The practice of reducing exposure to an existing investment by placing a derivative trade in the opposite direction. This might sound slightly confusing, but can be useful in mitigating short-term losses in your portfolio. As you now know, even a long-term winning share can experience short-term drops in price. For example, an upcoming financial results announcement from a company in which you have long-term holdings can negatively impact the value of your investment in the short term. If you're expecting this, you can temporarily take a short position on the company shares to limit the impacts to your portfolio. The falling share price will negatively affect your long-term holdings, but because you're making money on the short position you took, your combined investment and trading portfolio is relatively unaffected. Lesson summary: derivative products can be used to cover losses made in your shareholdings. Market conditions can throw your share portfolio out of balance and expose you to more risk than you initially intended. Balancing your portfolio regularly or as needed is important to make sure your portfolio remains within your risk tolerance. Hedging is when you have exposure to the same asset in both directions to mitigate your losses. Oh, in the same assets, right, okay. Yep. What are the risks of combining trading and investing? What are the risks combining trading and investing? There's no getting around the risks associated with derivative products. It's easy to lose track of the financial liability involved in trading with leverage. A leveraged trade going against you can cause damage to your wealth because any losses you incur are amplified. With a share dealing portfolio, you can't lose any more than the initial value of your shares, but with derivative instruments you could lose more than you invested. So you can't lose more than the initial value of your investments with shares in a share dealing portfolio. You can lose more than you invested in a when dealing with derivatives. It's incredibly important to use resources like demo trading environments before you start participating in financial markets in this way. You can sign up for a free demo account loaded with £10,000 in virtual funds. Use it to get a feel of how much exposure you get and what margin. Remember to start with a demo account. If you're using multiple products, it's important to consider your whole portfolio in your risk management strategy. Don't let short-term excitement become a hindrance to long-term wealth building. If executed poorly, a multi-product strategy can also introduce more risk to your portfolio. For instance, you can reduce the diversification in portfolio when you open trades that are highly correlated to your long-term holdings. This leaves you exposed to making losses in both your shares and your leveraged positions. When using multiple products, consider your whole portfolio in your risk management strategy. Don't let short-term excitement become a hindrance to long-term wealth building. If executed poorly, a multi-product strategy can also introduce more risk to your portfolio. For instance, you can reduce the diversification in portfolio when you open trades that are highly correlated to your long-term holdings. This leaves you exposed to making losses in both your shares and your leveraged positions. You could reduce diversification in your portfolio when you open trades that are highly correlated to your long-term holdings. This leaves you exposed to making losses in both your shares and your leveraged positions. Example: Consider the worst case scenario. Say you own shares in a few gold mining companies and you trade derivatives on occasion. You log into your trading account one day and find out the price of spot gold is rising quickly, so you buy 10 standard contracts to try and profit from the rally or increase. The following day, news breaks out about one of the biggest gold mines in the world caving in. It's owned by one of the companies you're invested in. The price of gold plummets well below your stop loss level and you lose all your capital. But because you also own shares in the company implicated, your portfolio loses money on two fronts. Right, I see, because when diversifying, don't make any links between them. Because if one thing happens to one, or if something happens to one asset, they might cause a positive or negative effect on the other one. So in this case, a negative thing happens to one asset class, and that also negatively affects another asset class. So yeah, make sure they're totally unrelated with each other. So finally, both leveraged trades and investments incur costs. It's important that you know all of the charges involved in making a trade, such as spreads, commission fees, and daily funding charges. So leveraged trades and investments incur costs. It's important to know all the charges involved in making a trade, e.g. spreads, commission fees, daily funding charges. Overtrading can have a negative effect on your account balance because each transaction you make may have accompanying costs. Because derivative products are designed to take advantage of short-term price movements, some of them are structured in a way that you'll be charged a fee when you hold them overnight. Always factor in money you lose to fees when you're considering opening a position. So, always factor in the money you'll lose to fees when you're considering opening a new position. So let's a summary then. Not having a formalized strategy in place when trading multiple products can have adverse effects on your wealth. Costs and charges associated with trading and investing can eat at your funds if you don't manage it. If diversification is executed poorly, it could leave your portfolio overexposed to risk. Is combining trading and investing right for me? Trading right for me. Because of the risks involved, a strategy that combines trading and investing is not for everyone. It's important to have a strong financial foundation before adding leveraged products to your portfolio. You should also make sure you have the financial stability to withstand the increased risk of losses when you add derivative products to your portfolio. In order to determine this, you should consider the following. A strategy that combines trading and investing isn't for everyone due to the risks involved. Sure you have a strong financial foundation and the financial stability to withstand the risk of loss. When you add derivative products to your portfolio, in order to determine this, you could consider the following. Consider the following to determine if combining trading and investing is right for you. If I lost my income, I'll be able to pay my living expenses for at least 3 months. If I lost my income, I'd be able to pay my living expenses for 3 months. For at least 3 months. If I got into an accident or something happened to my belongings, I have the right short-term and long-term insurance to deal with the financial impact. If I got into an accident or something happened to my belongings, I have the right short-term and long-term insurance to deal with the financial impact. I have long-term savings specifically set aside for my retirement. I have long-term savings specifically set aside for my retirement. I've taken advantage of all the tax-free or tax-efficient investment allocations available to me. I've taken advantage of all the tax-free or tax-efficient investment allocations available to me. I think in the UK it's like £20,000 per year, 20,000, something like that. I have an appropriate long-term investment. I have an appropriate long-term investment strategy suited to my financial goals and needs. Strategy suited to my financial goals and needs. I have an appropriate long-term investment strategy suited to my financial goals and needs. I have an appropriate long-term investment strategy suited to my financial goals and needs. Homework. Your success in using both trading and investment products will depend on how well you understand the correlation between the shares you own in your long-term portfolio and those you prefer to trade instead. Your success in using both trading and investment products will depend on how well you understand the correlation between the shares you own, in the long-term portfolio and those you prefer to trade instead. Play around with this tool to see how different asset classes, share dealing versus turbos POC. Play around with this tool to see how different asset classes correlate with one another. If you ran this experiment with your favorite share and currency pair, do you understand how the one would affect the other? So look at how different asset classes correlate with each other. So do they have positive correlation? So if one goes up, the other goes up. Do they have negative correlation? If one goes up, the other goes down? Was it inverse or something like that? If one goes up, the other goes down. I think it's inverse. So are they positively correlated? Are they inversely correlated? Or have they got no correlation at all? So you need to do some research on see which asset classes has positive, inverse, or no correlation with the other asset classes. Lesson summary then. Derivatives are complex products, so it's important to have the right knowledge before trading them. Only add derivatives to your portfolio if you can handle potentially losing large amounts of money. Only add derivatives to your portfolio if you can handle potentially losing large amounts of money. Only add derivatives to your portfolio if you can handle losing large money. In the next video, we're going to finish doing the quiz for this, or starting off with finishing the quiz for this, and then we'll move on to the advanced courses, I think, because this is the last of the intermediate courses, so which would be good. So yeah, thank you all for watching, and I'll see you guys in the next video. Bye bye.